A financial statement is the combination of the three major reports on a business. It will contain the cash flow statement, the income statement and the balance sheet of the business. All three together produce an overall picture of the health of the business. Why is a financial statement important? The answer to this question is in the definition. It is the complete report on the health of the business taking in cash flow, income, and the balance sheet. The financial statement determines if a business has the ability to repay loans, if it has the cash flow to meet bills and purchase stock. It will also tell from where the business is generating cash and where the cash goes. The financial statement tells if the business is profitable, if it will stay profitable and if there are any large problems looming, such as a continuous drop in sales over time. Reading the financial statement will give an overall view of the condition of the business and if there are any warning signs of possible future problems. A bank or other such institution will look to the financial statement as the first indicator of how the business is performing and if there is a need for further investigation. When will a company prepare a financial statement? Every business will ready a financial statement to go with their end-of-year results, to give interested parties the overview of how the business is functioning. If a business is looking to increase credit facilities with a bank or trying to raise capital for an expansion, it will produce a financial statement for the end of a fiscal quarter or the most recent month. When preparing a financial statement for such purposes, the best practice is to use general accountancy language, understood by all parties. A financial statement that may accompany an end-of-year report and read just by employees, is often in terms familiar to just those involved. Often a government body may request a financial statement for tax purposes and the company will need to produce one of high quality using generally accepted guidelines. A bank or investors may also request a financial statement without warning, if they are concerned about the profitability or otherwise of the company. For these reasons alone, it is vital for any business to keep good and current records so that a financial statement is easy and quick to produce. Reference: https://www.shopify.com/blog/what-is-financial-statement $. Financial statements, or financial reports, are formal records of the financial activities and position of a business, person, or other entity. Relevant financial information is presented in a structured manner and in a form which is easy to understand. They typically include 4 basic financial statements accompanied by a management discussion and analysis. A balance sheet reports on a company's assets, liabilities, and owner's equity at a given point in time. An income statement reports on a company's income, expenses, and profits over a stated period. A profit and loss statement provides information on the operation of the enterprise. These include sales and the various expenses incurred during the stated period. A statement of changes in equity reports on the changes in equity of the company over a stated period. A cash flow statement reports on a company's cash flow activities, particularly its operating, investing, and financing activities over a stated period. Notably, a balance sheet represents a snapshot in time, whereas the income statement, the statement of changes in equity, and the cash flow statement each represent activities over an accounting period. By understanding the key functional statements within the balance sheet, business owners and financial professionals can make informed decisions that drive growth and stability. Purpose of financial statements. The objective of financial statements is to provide information about the financial position, performance, and changes in financial position of an enterprise that is useful to a wide range of users in making economic decisions. Financial statements should be understandable, relevant, reliable, and comparable. Reported assets, liabilities, equity, income, and expenses are directly related to an organization's financial position. Financial statements are intended to be understandable by readers who have a reasonable knowledge of business and economic activities and accounting and who are willing to study the information diligently. Financial statements may be used by users for different purposes. Owners and managers require financial statements to make important business decisions that affect its continued operations. Financial analysis is then performed on these statements to provide management with a more detailed understanding of the figures. These statements are also used as part of management's annual report to the stockholders. Employees also need these reports in making collective bargaining agreements, CBA, with the management, in the case of labor unions or for individuals in discussing their compensation, promotion, and rankings. Prospective investors make use of financial statements to assess the viability of investing in a business. Financial analyses are often used by investors and are prepared by professionals, financial analysts, thus providing them with the basis for making investment decisions. Financial institutions, banks and other lending companies, use them to decide whether to grant a company with fresh working capital or extend debt securities, such as a long-term bank loan or debentures, to finance expansion and other significant expenditures. Stockholders may from time to time request insight into how share capital is managed, which may be made available via financial statements, or stock statements, as it lies in the financial interest of share owners in affirming that capital stock is handled viably and mindfully with duly care. Consolidated financial statements are defined as financial statements of a group in which the assets, liabilities, equity, income, expenses, and cash flows of the parent company and its subsidiaries are presented as those of a single economic entity, according to International Accounting Standard 27 Consolidated and Separate Financial Statements, and International Financial Reporting Standard 10 Consolidated Financial Statements. Standards and regulations. Different countries have developed their own accounting principles over time, making international comparisons of companies difficult. To ensure uniformity and comparability between financial statements prepared by different companies, a set of guidelines and rules are used. Commonly referred to as Generally Accepted Accounting Principles, GAAP, these set of guidelines provide the basis in the preparation of financial statements, although many companies voluntarily disclose information beyond the scope of such requirements. Recently there has been a push towards standardizing accounting rules made by the International Accounting Standards Board, IASB. IASB develops international financial reporting standards that have been adopted by Australia, Canada, and the European Union, for publicly quoted companies only, are under consideration in South Africa and other countries. The United States Financial Accounting Standards Board has made a commitment to converge the US GAAP and IFRS over time. Management Discussion and Analysis. Management Discussion and Analysis, or MD&A, is an integrated part of a company's annual financial statements. The purpose of the MD&A is to provide a narrative explanation, through the eyes of management, of how an entity has performed in the past, its financial condition, and its future prospects. In so doing, the MD&A attempt to provide investors with complete, fair, and balanced information to help them decide whether to invest or continue to invest in an entity. The section contains a description of the year gone by and some of the key factors that influenced the business of the company in that year, as well as a fair and unbiased overview of the company's past, present, and future. MD&A typically describes the corporation's liquidity position, capital resources, results of its operations, underlying causes of material changes in financial statement items, such as asset impairment and restructuring charges, events of unusual or infrequent nature, such as mergers and acquisitions or share buybacks, positive and negative trends, effects of inflation, domestic and international market risks 11 and significant uncertainties. Financial statements are formal records that summarize a company's financial performance, and financial statements are reports businesses compile to record financial performance and health. They offer a clear, standardized picture to parties such as investors, creditors, and management, allowing them to assess operations and whether the business is headed in the right direction. Financial statements provide an overview of a company's financial health to stakeholders. The four primary types of financial statements are balance sheet, income statement, cash flow statement, and statement of shareholders' equity. Understanding how to read financial statements allows you to make informed investment decisions about a company's performance, stability, and future potential. Financial statements must present complex data in a clear and accessible way for everyone, from CEOs to average consumers. Financial statements organize important financial data so stakeholders, including board members, investors, shareholders, creditors, employees, customers, and analysts, can analyze the health of a company's finances. These statements must present complex data in a clear and accessible way for everyone, from CEOs to average consumers. Accountants prepare financial statements following specific accounting rules, like the Generally Accepted Accounting Principles, GAAP, for U.S. companies or the International Financial Reporting Standards, IFRS, for many international companies. These accounting standards ensure that financial statements are clear, consistent, and comparable, so financial data presentation is as similar as possible. There are 4 primary types of financial statements that provide valuable insights into a company's financial position and performance. A company's balance sheet provides stakeholders with a snapshot of its assets, liabilities, and shareholder equity at a specific point in time, typically the last day of the reporting period. Rather than predicting future success or trends, the balance sheet reflects the company's current financial position. The balance sheets follow the standard equation: assets equals liabilities plus equity. You must understand a few basic financial terms to read a balance sheet effectively. Assets. Assets represent what a company owns and are categorized as either current or non-current assets. Current assets. Current assets, often considered short-term assets, can be converted into cash within the firm's fiscal year. Cash and cash equivalents, any highly liquid asset, like cash, checking accounts, or money market funds. Accounts receivable, money owed by customers. Inventory, products or raw materials used for products. Prepaid expenses, payments made in advance for expenses like rent or insurance. Non-current assets. These assets, also called long-term assets, are critical for a company's success but cannot be converted into cash within the firm's fiscal year. Property, plant, and equipment, PP&E, buildings, machinery, vehicles, or other equipment. Intangible assets, non-physical assets like patents and trademarks. Long-term investments, stocks, bonds, or notes held more than 1 year. Deferred tax assets, taxes due back for overpayment or advance payment. Liabilities. Current liabilities. The liabilities due within a year. Accounts payable, money owed to suppliers and vendors. Short-term debt, loans or credit lines due within the year. Accrued expenses, incurred, but unpaid costs like wages or taxes. Unearned revenue, money received for goods or services not yet delivered. Non-current liabilities. Often called long-term liabilities, these are the company's financial obligations not due within a year. Long-term debt, debt payable in more than 1 year, such as bonds or long-term loans. Deferred tax liabilities, future tax payments. Pension liabilities, employee retirement benefits obligations. Lease liabilities, long-term lease commitments for buildings or equipment. Equity. Equity, also called net assets, represents the company's assets minus its liabilities. Net assets are payable to shareholders. Common stock/preferred stock, value of issued shares. Retained earnings, profits not distributed as dividends. Treasury stock, the company's repurchased stock. An income statement overviews a company's revenues, expenses, net income, and earnings per share over a specified period, such as a quarter or a year. It answers the question, did the company make money? Income statements help stakeholders assess financial health and management success by comparing income statements across multiple periods. Key components of income statements. Revenue, total income from sales or services rendered. Cost of goods sold, COGS, cost of producing goods. Gross profit, all revenue minus the cost of goods sold. Operating expenses, costs to run the company, such as rent, salaries, and utilities. Net income, the final profit after paying all expenses and taxes. Important. This statement has a few key components, but the formula for calculating shareholder equity varies from company to company. Comprehensive income. Comprehensive income expands equity exploration by including items not typically seen on a traditional income statement. It accounts for adjustments in securities held for sale by the firm, unrealized gains or losses on investments, hedging activities, foreign currency exchange rate changes, and adjustments to future pensions. Some companies produce a separate statement for comprehensive income, while others include it as a footnote on the income statement. While it is easy to overlook, comprehensive income gives a much fuller picture of the company's financial position. A company's cash flow statement, CFS, tracks the movement of cash into and out of the business over time. The primary purpose of the CFS is to show stakeholders where a company's money is coming from and how management is spending it. Cash flow statements are divided into three categories. Operating activities, cash from day-to-day business operations. Investing activities, cash spent on or earned from investments. Financing activities, cash made from borrowing, debt repayment, or issuing stock. The cash flow statement shows where money went and if there is enough left or incoming to sustain future operations. The statement of shareholders' equity shows how a company's equity changes over a reporting period. It complements the balance sheet and helps assess whether the company's stock is profitable. Another way to use the statement of shareholders' equity is to assess how much money is left for shareholders after the company pays all liabilities and accounts for all assets. The leftover equity should accurately reflect the cost per share. A positive number signals stability, while a negative result may indicate looming financial trouble, possibly even bankruptcy. Until the Securities and Exchange Commission, SEC, through the Securities Act of 1933 and the Securities Exchange Act of 1934, mandated that public companies have audits, financial statements were merely something some companies used to attract investors. 1 However, after the 1929 stock market crash and the Great Depression, mistrust grew due to manipulated financial data. As the stock market and regulations evolved, independent auditors established standard reporting procedures to keep financial statements transparent and uniform. Today, several international and national standards boards regulate reporting structures to ensure that companies report accurate and transparent information. Limitations of financial statements. While financial statements are informative, they have limitations. Historical data. Financial statements report past performance and rely on interpretation to predict future success. Non-financial information, important factors, such as brand reputation, employee morale, and market position, are not captured. Inflation. Financial statements do not account for inflation, and assets and liabilities are often recorded at historical costs. Reporting periods. Differences in reporting periods and estimates or assumptions used by management make cross-company comparisons challenging. To read financial statements, you must understand key terms and the purpose of the four main reports: balance sheet, income statement, cash flow statement, and statement of shareholder equity. Balance sheets reveal what the company owns versus owes. Income statements show profitability over time. Cash flow statements track the flow of money in and out of the company. The statement of shareholder equity shows what profits or losses shareholders would have if the company liquidated today. 2. The core structure of financial statements is the same worldwide, but the accounting rules differ depending on which standard the company follows based on its locality or trading location. U.S. companies are required to use generally accepted accounting principles, GAAP, while foreign companies may use International Financial Reporting Standards, IFRS. 3. Financial statements give a company's stakeholders, such as investors, board members, creditors, employees, and analysts, a picture of a company's financial performance and stability. They help stakeholders assess profitability and overall economic health to make decisions about investing in, lending to, or working with the company. Financial statements are important tools for evaluating a company's financial health and future projections. There are four main types of financial statements: balance statements, income statements, cash flow statements, and statements of shareholders' equity, each with a specific purpose in detailing the company's financials. Whether you're an investor looking for new opportunities, a CEO seeking a quick snapshot of a company's finances, or someone curious about the inner financial workings of a company, knowing how to read and interpret these statements is a measure of financial literacy that will pay future dividends. Thank you for watching this video.